Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
All right, let's get right into it. Today, we're doing a deep dive into a source document titled US Market Peripheral Notes from Thursday, March 19th, 2026.
Now, just to be perfectly clear, this is a direct informational narration. We're sticking strictly to the analysis and the data presented in this document.
Okay, first things first, the standard risk disclosure. This content is for informational and research purposes only. It doesn't constitute investment advice, and it's not a recommendation or an offer to buy or sell anything. As always, investing involves significant risk, and that includes the potential loss of your principal.
So here's our roadmap. We'll kick things off with the big picture, the macro environment. Then we'll zoom in on the intraday market movers, followed by index technicals and flows. After that, we'll peek at the near-term outlook, look at some key stock observations, and then tie it all together with a conclusion and a tactical framework.
Let's start with Section 1, the macro environment. The source describes the current situation as a managed drawdown happening under a global liquidity contraction. You know, on that Thursday, March 19th, all three major U.S. indices took a pretty meaningful hit. The whole logic of the market seems to be shifting from just a simple growth scare to something deeper, a real compression in the equity risk premium. That's that extra return you expect for taking on the risk of owning stocks.
The document points to this perfect storm of three main headwinds all hitting at once. First, there's a geopolitical premium building up, thanks to the conflict in the Middle East, which is also feeding into inflation starting to accelerate again. Then you've got a sharp pivot from the Fed, which really just means higher for longer rates, and that's pouring salt in the wound of an already tight global liquidity situation. And finally, all of this is leading to a global catch-up to the downside as risk assets everywhere get repriced.
So, what does this all feel like? Well, the document calls it a classic resistance-style decline. This means that when we get reassuring comments, say from the White House, they don't actually stop the bleeding. They just kind of slow the descent for a little while before it continues.
Okay, let's dig a little deeper into the day itself. Section 2 covers the intraday market movers, really zeroing in on those geopolitical shifts and some serious warnings coming from the bond market. This is where you can really see the market's nerves in real time. Right around 3 p.m., there was this wild V-shaped roller coaster ride, all kicked off by a speech from Israeli Prime Minister Netanyahu. At first, there was this flash of optimism, a quick illusion of de-escalation. Fast money piled in aggressively. But just minutes later, the tone turned hawkish, and poof, all that optimism was gone. The market completely reversed. And what this little episode tells us is pretty revealing. The market was way more sensitive to what Netanyahu said than to what the White House said. It suggests that capital has sort of accepted this slow, managed drawdown, but it's now on high alert for any geopolitical surprises that could throw that fragile balance into chaos.
And all the while, the 10-year U.S. Treasury yield is just hanging over the market like the sword of Damocles. The document highlights a crucial line in the sand that everyone is watching, 4.3%. If that level breaks and yields start pushing towards 4.5%, well, the whole valuation model for U.S. stocks could face another leg down. We're also getting another warning sign, this time from precious metals. Gold broke below its 6-month moving average. Silver's been hammered. Now, when traditional safe havens like these don't act like safe havens, it's a big red flag. The document says this isn't your typical risk-off move. It's a reflection of a serious deleveraging phase caused by that extreme liquidity crunch we talked about.
All right, let's shift gears and look at the charts. Section 3, Index Technicals and Flows. The story here is about a rising risk of a double top formation and a very concerning lack of outright panic.
So from a technical standpoint, the indices are in a pretty dangerous spot. The S&P 500 gapped lower and ran right into a ceiling at its 200-day moving average. Meanwhile, the Nasdaq, the QQQ, has officially broken below its key lifeline at 595. If it can't get back above that level soon, that would confirm a double top, which could open the door to a much deeper slide.
And if you look at who's buying and selling, the picture doesn't get much brighter. According to JP Morgan data, retail inflows dropped another 15% this week. That brings the total drop to 43% since the conflict started on February 28th. And at the same time, corporations aren't buying back their stock, and a lot of the big institutional buying power is just exhausted.
But maybe the most telling and frankly dangerous signal of all, the VIX, the so-called fear index.
Even with all these support levels breaking, the VIX is just hovering around 25. It hasn't spiked above 30, which is usually where you see full-blown panic. This suggests that all the bearishness hasn't really been washed out of the system yet.
So, with all that in mind, what's next? Section 4 looks at the near-term outlook. And interestingly, the document suggests we might see a bit of a temporary break thanks to Triple Witching Friday.
The trading logic here is actually pretty straightforward. Because the market has been selling off all week, a lot of short sellers are sitting on some really nice gains. With options expiring, they're likely to take some profits by buying back their shorts. That short covering could easily be the dominant flow. So the key levels to watch are the 6,700 area on the upside, which is a big supply zone, and the 6,475 level on the downside, where a big JPM collar position should offer some solid support.
Okay, now let's zoom in from the broad market to some specific names. Section 5 is all about key stock observations, with some notes on individual stocks and industries.
First up, Micron. Their $25 billion spending plan raised some eyebrows about cash flow, but you can see there was still clear dip buying in that whole AI infrastructure theme, with the stock closing down only about 3.78% after being down as much as 8%. Then there's NVIDIA, which the document calls the rhythm setter. It managed to bounce after breaking its 200-day moving average, but it still has a gap to fill. And finally, that big $1.25 billion deal between Rivian and Uber is viewed as a long-term win that was pretty much monetized instantly in the short term.
Now for an interesting one, Fannie Mae and Freddie Mac. They're down 70% from their highs after the government made a request that the market saw as treating them like administrative tools. Bill Ackman, though, has a completely different take. He sees it as a long-term macro arbitrage play and calls the investment, quote, a lottery ticket in the drawer. And finally, let's look at Alibaba. The earnings were not good. Revenue is up only 2% and net income fell a staggering 70%. It's no surprise that the strategist's view on Chinese ADRs is still pretty cold. The advice is, unless the data really turns around, any rebound should be seen as a chance to get out.
And that brings us to our final section, the conclusion and tactical trading framework. The big idea here is that in this kind of market, rhythm matters a lot more than direction. We're in a painful transition from a fantasy of rate cuts to the reality of higher rates. And that means volatility is probably going to stick around.
So, the document lays out a three-part tactical framework. Think of these as the rules of the road. Rule 1. Recognize the rhythm of this resistant-style decline. Don't panic sell at support, and don't chase rallies into resistance. Rule 2 is about discipline. Use a staged approach. Wait for the market to stabilize in that 6475 to 6500 zone, and think about reducing risk up near 6700. And Rule 3 is the survival rule for Chinese ADRs. Just don't try to catch a falling knife.
So, in the end, it really all boils down to this one single question. Can the QQQ reclaim 595 on Monday? That's the swing factor for the entire market. Until that happens, the advice is to keep cash levels high, wait for that short covering window from triple witching to play out, and avoid making any big long-term directional bets right now.